Hi everyone, my name is Frederick Wong, and I'll be presenting to you the case of Thomas versus the Federal Commissioner of Tax 2015. The parties included in this case were Mr. Mark Thomas, who will be referred to as Mr. Thomas, and Mr. Jack Thomas, who will be referred to as Mr. Thomas Sr. Mr. Thomas Sr. is the father of Mr. Thomas, as well as the registered tax agent that represented Mr. Thomas in the hearings of the case. So the main issues that arose from this case revolves around deductions, especially self-education expenses. The self-education expenses incurred in this case were costs paid after redundancy. The issue was whether these costs were refundable or non-refundable expenses, and whether these costs were actually incurred or not. There was also the issue of whether sufficient nexus existed with gaining or producing of the assessable income. There was also the issue of penalties, whether the penalties applied to Mr. Thomas and Mr. Thomas Sr. for the failure to take reasonable care. In April 2010, Mr. Thomas secured employment as an associate director in NAB. After about 18 months into his employment, Mr. Thomas decided to undertake further study. He chose to do an MBA course and decided to aim for the prestigious HEC Paris. He undertook the Graduate Management Admission Test in May 2012 and then applied to and was accepted by HEC Paris in July 2012. The course was commenced in January 2013. Initially, NAB seemed to be generally supportive of Mr. Thomas's desire to undertake the course full-time. This would take him out of the workforce for 16 months. However, before he could make a formal application for leave, Mr. Thomas was made redundant on 16th November 2012. After his redundancy, Mr. Thomas did not earn any salary or wages for the remainder of 2013 income year, or at all during the 2014 income year. By the time he was made redundant, Mr. Thomas had already paid for his flight to Paris and has also paid for the visa enabling him to do the MBA course. Although Mr. Thomas's deduction claims for these items of expenditure were initially disallowed, the Commission now accepts that they are allowable deductions. But the main issue lies within the course fees. The course fees had 3 installments. So before being made redundant, Mr. Thomas had actually paid the first installment of the course fees, to which the Commissioner has now accepted as deductible. The second installment was paid on the 28th of November 2012, and the third payment was due in March 2013 and paid during the 2013 income year. These 2 installments were not accepted by the Commissioner as deductible. The reason behind that is because the Commissioner says that the second and third installments were not only paid, but more importantly incurred at a time after Mr. Thomas was made redundant, which means that the necessary nexus between the incurring of the outgoing and Mr. Thomas's gaining or producing of assessable income had been broken. Mr. Thomas argues that although the second and third installments were paid after he left NAB, he had actually committed to them before he was made redundant, and so he incurred the expenses while he was still employed. Mr. Thomas Sr., who represented Mr. Thomas in the hearings, stated that Mr. Thomas had to sign a payment agreement with HEC Paris, accepting his liability to pay the course fees. He also stated that he himself had to sign a guarantor's contract, which guaranteed the payment of those fees. On the day of the hearing, Mr. Thomas Sr. was unable to provide these documents to the tribunal. A short time after the decision was reserved, Mr. Thomas Sr. approached the tribunal with a request to reopen the hearing, since they had now located the documents that Mr. Thomas and Mr. Thomas Sr. had signed on the 14th of November 2012, to which the Commissioner had opposed to the application to reopen. On 28th of May 2015, the judge conducted a directions hearing to hear from the parties on the application to reopen. He told the parties at the conclusion of that hearing that he would reserve his decision on whether leave should be granted to reopen, and that he would include his rulings in these final reasons for decision. In the interest of justice, he now grants the leave to reopen. with the result that he will take into account the signed documents produced to the tribunal. The issue that arises is whether Mr. Thomas had incurred a loss or outgoing. A loss or outgoing can be incurred by a taxpayer even if money has not yet been paid out. In the case of Neville, the High Court considered the deductibility of expenditure under Section 23 of the then Income Tax Assessment Act 1922, which is the current Section 8-11A. The word used in the Act is incurred and not made or paid. This suggests that if a liability to pay money as an outgoing comes into existence, the quoted words of the section are satisfied, even though the liability has not been actually discharged at the relevant time. It is only the incurring of the outgoing that must be actual. The section does not say in terms that there must be an actual outgoing. Section 8-1 of the ITAA 97 has defined the word incurred to have the requirement that there be a presently existing liability, that the taxpayer be definitely committed to the outgoing, and that the losses or outgoings that are no more than impending, threatened, or expected are not deductible. And the cases that help define the word incurred were the Nielsen case, the Jamesford case, and the New Zealand Flax investment case. So the question now is, when were the second and third installments incurred? Mr. Thomas says both amounts were incurred on 14th of November 2012, when him and his father signed the payment agreement and the guarantor's contract, to which he relies on the terms used in the documents, which says that each of the men on that day have committed to paying the course fees. The Commissioner points out the terms used in the documents, particularly the payment agreement. He highlights the fact that the first installment is described as non-refundable, but the second and third are not. The judge said if it were clear from the documents, and the documents were all that he had to go by, that the second and third installments or either of them had to be paid even if Mr. Thomas changed his mind and withdrew from the course, then he would agree with Mr. Thomas's submission that he incurred those amounts on the 14th of November 2012. But it is not clear that that is the position. The judge also said that there was no doubt the description of the first installment as non-refundable flagged to the prospective students that once the payment was made, there was no prospect of getting the money back. In effect, the first installment secured the student's position in the course, but if for any reason the position were not taken up, the money would still stay with Heck Paris. But the second and third installments are not described in the same way, so a number of questions were raised. What would the position have been if, say, Mr. Thomas had decided not to go ahead with the course? What if he had withdrawn from the due date for payment of the second installment, which is the 3rd of December 2012? Would HEC Paris have been entitled to recover the fee from him and his father? Or, if he had paid the second installment by the due date, but then changed his mind before the start of the course in January 2013, would HEC Paris have refunded that installment, or would it have kept that installment and insisted on the payment of the third? The answers to the questions are relevant to the question whether Mr. Thomas was definitely committed on the 14th of November 2012 to the second and third installment amounts, which the judge said, unfortunately, I do not have the answers to those questions. It is not clear to me that the commitment the men were making was anything more than a commitment to pay the fees if Mr. Thomas went ahead with his study. I am not satisfied as I need to be that they are committed to paying the fees no matter what. On the material before me, I am not satisfied that Mr. Thomas incurred those amounts on the 14th of November 2012, rather than when he actually paid them. In other words, I am not satisfied that these amounts were incurred while he was still employed with NAB. So the issue now is whether the second and third installments are deductible. A number of cases that help determine the phrase of incurred in gaining or producing assessable income are the Amalgamated Zinc, the Neville case, the Rompibon Tin, and the Cooper case. The assessable income referred to in the Section 8-11A is not restricted to the assessable income you gain or produce in the income year in which the loss or outgoing is concerned. A number of cases also helped in determining this. These cases are the Amalgamated Zinc, the Rompibon Tin, the Finn case, and the Fletcher case. Had Mr. Thomas remained in employment with NAB and had incurred the expenditure on the MBA course while he remained an employee, there would have been no dispute about the deductibility of the expenditure. In this hypothetical scenario, similar to the Finn's case, the facts would be that the increased knowledge obtained from the course would have made an advancement in his job more likely. The advancement in his job formed a real and substantial element in the motive for doing the course. the employer would likely have regarded his increased knowledge to be a distinct advantage to his work, and the course would have been done while he was in NAB's employment, earning his salary and acting in accordance with the conditions, or, perhaps more generously, the expectations of his service. But having failed to establish that he incurred the disputed amounts before his employment ceased, Mr. Thomas is unable to show that the outgoing was incurred in the course of gaining or producing his assessable income, which according to authorities he is required to show. Mr. Thomas's case is then comparatively similar to the Roberts case, where the taxpayer is a mining engineer who was retrenched shortly before commencing his MBA. Before being retrenched, he was negotiating with another mining company with a view to gain employment. That company indicated that there may be an opportunity in the future where completion of an MBA would be desirable. While the negotiations did not result in a job offer at the time, the taxpayer was offered a job at the company later, just before completing his MBA. The federal court disallowed the deductions relating to the MBA course. His Honor found that the expenditure was spent to obtain new employment rather than being incurred in the course of earning his employment income. The facts in Mr. Thomas's case are different in that he did not incur the MBA fees for the purpose of securing a particular alternative employing posting, or indeed any employment at all. Nevertheless, the judge agreed with the Commissioner's submission that, as occurred with the taxpayer in Roberts' case, the nexus with any income-generating activity was lost once his employment with NAB was seized. It does not matter that Mr. Thomas accepted the position in the MBA course while he was still employed. What matters is that he did not incur the expenditure while he was employed. It is for that reason that he cannot have incurred the expenditure in gaining or producing his assessable income. With that, a penalty was assessed at 25% for the failure to take reasonable care. Thomas's tax return for 2013 was lodged on the 3rd of February 2014, which is a late lodgement. On the day before lodging the return, Mr. Thomas Sr. wrote a note of the matters he took into account to support the deduction claim for the expenditure relating to the HEC Paris course, which included a number of legislations, cases, and tax rulings. In summary, Mr. Thomas submits that he and his tax agent father did not fail to take reasonable care, but even if they did, the safe harbor provision in Section 284-75(6) applies. Subsection reads as follows: not liable to an administrative penalty under subsection 1 or 4 if a. you engage registered tax agent, and b. you give the registered tax agent all relevant information, and c. the registered tax agent makes a statement, and d. the false or misleading nature of the statement did not result from intentional disregard by the registered tax agent of a taxation law or recklessness by the agent as to the operation of a taxation law. To which subsection 7 provides, if you wish to rely on subsection 6, you bear an evidential burden in relation to paragraph 6b, which the judge accepted Mr. Thomas Sr.'s consideration to the relevant issues, but decided that the conclusion was wrong. This is because Mr. Thomas Sr. sees that him and his son are definitely committed to the course fees as they signed the HEC Paris documents before Mr. Thomas was made redundant. To which the judge said that was hardly an unreasonable view, even if it was wrong. Table item 3 in section 284-91 in schedule 1 to the TAA is not engaged. As a result, the administrative penalty falls away. The judge says, if I am wrong with that, I consider that the safe harbor provision in section 284-75(6) applies. So there is no dispute that paragraphs C and D of section 284-75(6) apply. The real question is whether, in terms of paragraph B, Mr. Thomas gave his father all relevant taxation information. The answer to that must be yes. It is clear that Mr. Thomas Sr. was fully apprised of his son's arrangement with HEC Paris. He was, after all, guaranteeing the payment of the fees, and of NAB's having made his son redundant. They are items of information that are relevant. In conclusion, with the exception of the concessions made by the Commissioner before and during the hearing, the objection decision relating to the assessment of primary tax is affirmed. The objection decision relating to assessment of administrative penalty is set aside. Instead, the tribunal allows the objection in full.